First up, let's welcome on board Steve Englander. He's from Standard Chartered Bank, the global head G10 FX Research. Steve, hi. Thank you so much for making time and speaking with us. First up, your reading of this Fitch downgrade and what you make of it?
You know, I think it's induced a panic in the market, and it's pure risk premium. It's not as if you see US CDS going up meaningfully. You're not seeing expectations of US Fed rates going up. What you're seeing is just the market bidding up yields because it's an unknown factor, a new unknown in the equation. This concern about the medium-term US fiscal stance. I actually think it's going to fade, that the market will get past this once things settle down. Just as an example, Australia and New Zealand are AAA countries. And, their yields really didn't benefit from the US being downgraded and their currencies got pummeled. So I think we're looking at a situation where the market is trying to digest this, but once it's digested, I think we'll go back to kind of towards where we were before the announcement came out.
Fair enough. So that's a commentary coming in. But do you think this 10-year move that we have seen already over the last 1 to 2 months or 1 to 2 weeks rather, do you think that's likely to continue on the upside for 10-year?
I think that a lot of it is the market being concerned that the US is not going to slow down, that the US economy isn't slowing down. And so I think it will last just until we get some concrete indication of US weakness. It could be Friday if payrolls come in on the soft side. I think the market consensus is about 200,000, but I would guess that the whisper number is actually a bit higher right now. So if we get anything under 200,000, I think that yield will come off very, very quickly.
Steve, so do you think this Fitch rating is going to be dismissed? And in hindsight, when we will look back, it would be just passé?
Let me put it this way. I think everything that Fitch said is true. That the US fiscal regime is unsustainable, that there's long-term issues that they've not begun to address, that they have no coherent way of managing their short-term budget. But it was equally true a month ago, the day before, or the day before the Fitch thing came out. So I think the market will get past it. I do think that there is an issue that the US has to discuss, that they raised spending a lot. It went from about 20% of GDP to 25% of GDP. It's going to come back to maybe 22.5%. But, that's a big long-term increase. And the debt ceiling deal and the budget deal didn't do anything really to lower that significantly. So there's a fiscal bullet that they're going to have to bite eventually.
Okay, so that's a take coming in, but I'm not sure, Steve, if you have a view on this, but what about the equity markets? Because, of course, they were seeing quite a bit of rally this year and all of those technology and the platform companies were doing rather well. Given the, entire commentary coming now, do you think there is a chance that we are in for a sharp correction in the equity markets as well?
Look, I think the equity markets were over-enthusiastic over the last couple of months. I don't think that the Fitch reason is any reason for them to sell off, but I think that if we're right that the US is going into a moderate recession, it's actually going to be good for risk appetite because it will lower the discount factor in all asset markets. And it will be good for US assets, it will be good for global assets. And again, I'm not going to speak to whether or not this particular level is justified. It does seem a bit rich. But, I wouldn't sell US equities because it was a Fitch downgrade.
All right, Steve, really appreciate your time. And thank you so very much for joining us.